get started discussing relative strength index. Now, before we get into the class, if you notice on your screen, there are several handouts that I put together just for you tonight. There's one that's the introduction to technical analysis. There's understanding technical indicators. And lastly, one that goes right along with tonight's class, relative strength index guide and handout. Now, you need to click the download button now to download these because you cannot get them in the recorded version. So please download them to whatever device you're using, and then you can move them around all you want afterwards. So please just make sure you do it, because a lot of people email us or call us afterwards and ask us for links to get these, and they're only available during the live class. So the next time we give this class, you'll be able to get them again, but only in this class. Now, the relative strength index, or RSI, is one of the most well-known and most used indicators in the marketplace. It was introduced by Wells Wilder when he published his book in 1978. So as you see, RSI has been around for a very, very long time and has lasted the test of time because it works extremely well. And it works well in all markets. Now tonight, we're not going to go deep into the mathematics. Now we will look at them so you understand how the mathematical equation for RSIs works, but we're going to only do it briefly because today you don't have to do any calculations. You can just drop it on your chart. Now, RSI attempts to identify when an asset becomes overbought or oversold. In other words, it's a momentum indicator. So if you imagine a rocket fired up into the sky, there's a certain point in which it starts losing its momentum. Now, it doesn't mean it's going to turn over and come right back down to Earth. It's still going to have enough momentum to still carry it upward. But it's telling you it's starting to lose that speed, and therefore it's going to flip back and come back to the Earth. The thing is, we don't know exactly when it's going to flip down because there's many, many factors. You know, even scientists with huge computers can predict when it should come back to Earth, but because of wind and temperature and all the types of velocities and everything else, you can only predict within so much accuracy. Well, we don't have a billion advanced computers doing all of this, so we need indicators, and RSI does exactly that. It tells us when an asset begins to lose its momentum and is getting ready to flip back over. But not that it's going to flip at this second. It's telling you that it's losing its momentum. Now, RSI falls in a category of indicators known as oscillators. In fact, it falls into a category known as a bounded oscillator. Now, an oscillator is a technical tool we as traders use to give us an indication of whether an instrument is overbought or oversold. Now, again, this term overbought and oversold doesn't mean buy or sell. It's very easy to say that this is what they are, their transaction signal to buy or sell, but they're not, because an asset that is overbought can remain in its direction for a period of time. So just because an asset reaches an overbought zone doesn't mean it's coming right back down. So it's not telling you to sell at that point. It's telling you that it's losing its momentum. Now, oscillators are typically used in conjunction with other technical analysis tools to make trading decisions on entering trades. There are a few indicators like RSI, ROC, stochastics, okay? And tonight we're going to be primarily discussing RSI, but all of these other indicators fall into this grouping of momentum oscillators. So let's go over and take a look at this one of these on a live chart. So let me pop up a chart for us here. Now, when we look at this, we can see we have a price chart on the screen right here. And RSI is an indicator that it falls below, it's put below the price chart. Now, I've put it in purples, but you can stand, there's no color that you have to use. Okay, I've darkened the line, but I've done all this just so you can see it easily on your screen. But if you notice on the side of here, we have 30, 40, 50, 60, 70, 80, and RSI goes all the way up to a 100 level and starts at a 0 level. Well, the fact is, in this gray area or this purple area here is between 70 and 30. Now, these are the mathematical calculations when the RSI is calculated and then is plotted on this chart. So it's said when RSI is between 70 and 30, it's in dead man zone, uninteresting zone. Above 70, and that's the standard interpretation for a 14-period RSI, which is the standard way that Wells Wilder developed this, is over 70 is telling you that an asset is moving into overbought. When it's below 30, it's telling you an asset is oversold. So the areas between here and here generally have no use, but they do. But the standard definition, when people tell you RSI is over 70 or RSI is 74 and or RSI has reached the overbought zone, it's talking about breaking above this 70 level. And when they say it's oversold, it's breaking below this 30 level. Now, RSI can be customized. You can decide if you want less signals, and you can decide you're only going to use 80 and 20. In fact, you could change these if you wanted by just simply changing your settings, and we can change it to an 80-20 setting. But when you read all of the standard literature and analysis in the market, it's based on Wells Wilder of the 70 and 30, because this is what we've been using since 1978. Now, there's lots of gurus out there. There's lots of literature in the marketplace because this indicator is so well known, and they all have all their other types of explanations. Okay. They'll talk about using, instead of using an RSI 14-day period, you can use a 250-day period, a 22-day period. There's all types of things out there. And again, there's ways you can customize. It's still going to be an overbought and oversold indicator. And when you change its value, it's still going to go above 70 and up to 100 and still go below 30 and down to 0. Okay. It's just how the calculations go above and below it. And when it breaks those lines, what is it telling you? Okay. But most of us, and I've been trading for 45 years, so I've been trading longer than Wilder's had this out here. Okay. But most of us use standard calculations. Okay, you can follow, like I said, you can go and follow somebody in the marketplace and follow their analysis and their strategies and read about it and adjust it. But to me, then you have to test it and back test it. When you're using the standardized formulas, you know those are the ones that have withstood the test of time. Now, you might find that maybe in the Forex market or the asset you're particularly looking at, it gives you a better reading at 75. Okay. That's by the security, and that's your interpretation. But before we can get on with how you would actually use this indicator, let's go back and talk about how we actually calculate these numbers. So let me get my PowerPoint back up here on the screen. Okay. So our RSI's calculation is very easy. Is RSI is equal to 100 minus 100 divided by 1 plus RS. And RS is the average of the days when the instrument closed up or down. Okay. So you'll only have to understand this once, and I have a little presentation that'll show you in 20 seconds exactly how this is done. And then you never have to understand or do this calculation again, because all the charts automatically drop it on there for you, pre-calculated and ready to go. Okay, now, as I said, the calculation is pretty easy. It's a lot of little numbers, but the computers do it for us. But to simplify the calculation explanation, RSI has been broken down into its basic components. RS is the average gain and average loss. Okay, so the first average gain is equal to the sum of the gains over the last 14 periods. So if over the last 14 periods, 5 days it had gains and ended up higher, you would add them together and divide it by 14. Then you'd also take the average of the sum of the losses over the 14 periods. Now what happens is if there were only losses and no gains, that's always 0. If there's only gains and no losses, it's going to be 100. Okay. And that's how come RSI falls in between the 0 and 100. So the second and the subsequent calculations it really comes down to 13 previous gains or 13 periods going back, the gains, and then plus the gain of the current period, or the average loss, which is 13 plus the current one. Now, taking the prior value plus the current value is a smoothing technique similar to that used in calculating an exponential moving average. So in other words, you're not going back 14 periods and dividing it by 14. You're going back 13 periods, adding them together, averaging them, and then adding it to the 14th period. It's a little bit of an unusual moving average type calculation. But this also means that the RSI value becomes more accurate as the calculation period extends. Now, there are charts that use as much as 250 data points for the starting date of the chart when calculating its RSI value. To exactly replicate the RSI numbers, a formula would need to at least 250 data points. Now, Wilder's formula normalizes RS and turns it into an oscillator that fluctuates between 0 and 100. In fact, a plot of RS looks exactly as the same as the plot of the RSI. The normalization step makes it easier to identify extremes because RSI is range bound. In other words, remember I mentioned it was called a bounded oscillator because the RSI, if the RSI is 0 when the average gain equals 0, assuming that the 14 period RSI or a 0 RSI value the price moved lower all 14 periods. So therefore you didn't have any gain averages. So you had a 0, and whenever you multiply a 0 times the number, it always comes out to 0. That's standard math. If we take 3 times 0, it's always a 0. You take 9 times 0, it's a 0. When there was no gains in that period, the RSI is equal to 100 because you're starting out with the first number, taking the second. So the default look back period for RSI is 14. This is the standard one, but this can be lowered to increase sensitivity or raised to decrease sensitivity. Perhaps a 10-day RSI is more likely to reach overbought or oversold levels than a 20-day period RSI. The look back parameter also depends on the security's volatility. 14-day RSI for internet retailer Amazon is more likely to become more overbought or oversold than a 14-day for like Duke Energy because it doesn't move that much. Very rarely will you find Amazon, it moves a lot during the day, but it has gains and losses every day. Where Duke Energy might stay the same price for days on end, so it might have more times that it is pushed way into that overbought and oversold level. Now, RSI is considered overbought when above 70 and oversold when below 30. Now, you could raise the overbought to 80 and lower to 20, which will reduce the number of overbought and oversold readings. Short-term traders sometimes use a 2-period look back for overbought readings at 80 and 20. So now what markets can we apply RSI to? Since RSI measures the relative strength of the underlying market, it is a technical tool that can be applied to nearly all markets. However, it is commonly applied to more liquid, larger markets like Forex, stocks, and commodities. In a downtrend, RSI can remain oversold when the center line to determine market direction. So we use the center line to determine market direction. Settings can be adjusted for more or less oscillation. Now, oscillation is the movement up and down, up and down, up and down. Whether you're looking at RSI or you're looking at a radar screen, okay, it's the oscillator moving up and down. So by adjusting its sensitivity, you get less of this oscillation. Now, when we look at RSI, even though the center line isn't marked and it doesn't have any real value, this 50 line, okay, it's a significant point just telling us when the price, when we see RSI falling down to this 50 line, okay, we should see prices decreasing. When we see it moving up and above the 50 line, we should see prices increasing. Okay. So it's a simple directional tone. It's not telling you anything more than that. So the center line, which is the 50 line, can help you at least to stay on the side of the trend or letting you know that the trend is shifting. I just want to get my PowerPoint back up here. So when selecting the indicator to your charts, you will be prompted to change the parameters on the RSI. I would suggest that new traders keep it at the default setting of 14 as your period, and this 14 refer to the last 14-day trading periods. You can also use RSI value to 70 to 30, okay, which we've been discussing. I advise everybody, stay with the 70, 30, stay with the 14 period. Then you don't have to respond to the 70. You can look when you're part of trading is limiting the assets you're going to trade. You understand the personality of those assets. Too many traders today on, especially online platforms, trade way too many assets. So you don't get to know those assets very closely and very personally. You know, I traded for many years only agriculturals, and I traded orange juice, coffee, and that was it for many years, in cocoa. Okay. Now I trade maybe 10 different assets. So once you start trading these assets, you can start looking at your RSI and say, maybe for the euro pound, okay, we've seen in the past that it reacts more at the 82 and 85 level, or that it spends lots of time in the overbought level. So we're going to know that we're not going to look for any type of reaction until it's above the 85 level. Okay. Some stocks, again, the same. If you're trading Apple, Amazon, Google, these are very active stocks. But if you're trading something that isn't so active, say you're trading GE, okay, maybe it's less and it's more sensitive, or you can start seeing it makes lots of times it flips over just when it hits the 70 level. So when you know these more intricately, you'll be able to see which numbers fit that asset the best. So RSI is used in a number of ways. Three popular functions are overbought, oversold, RSI ranges, and divergence. Now, the media and analysis you're reading about, a lot of times you see in MarketWatch.com or CNN or Bloomberg that an asset's in the overbought level, or this asset's expected is overbought at the moment. This is usually just the media or the speaker, and he's referring to the RSI reading of that particular asset. So when the asset is above 70 or 80, it will show a strong run higher in price, which may not be sustainable, and therefore is due for a correction. So unfortunately, it's not easy buying when the indicator moves below 30 or selling when it's above 70. Please, I see all this stuff in the marketplace that are telling you to do that, but it's not correct. Remember, it's only telling you that has reached a point where it's losing its momentum and it's about to flip down. So let me share with you, I've put together a presentation to show you actually how to use this with live assets. And let me share that with you. And then we'll talk a little bit more how to apply this in your trading. So, like I said, we should always try to use the standard 14-day calculation and use, today these modern charts, depending on what charting service you're using, but almost everyone, and of course on the OFX platform, will allow you to decide whether you want to use the open, the close, the high, the low for your calculation. Well, most of us use the close for everything. They even offer the medium point to everything. Now, all of these just are available because computers will do anything for you today. But almost every indicator that I know of is based on the close price. But you can decide I want to modify it and I'll use the opener. You want to modify it and use the low or the high. You want to modify it and use the medium price. That's completely up to you. Now, we talked about in that little presentation, we saw how we saw going above 70 and below the 30. We talked about divergence. We also talked about recognizing the 50 line and that it's important. There's one other way of using RSI. Now, don't worry. All of this is in that handout I gave you on RSI. Okay. All the charts are in there. All the explanations are in there. But one of the other ones is a little bit more complex, but is very, very good to start using once you've mastered it. It's called failure swings. And Wilder outlines another important indicator potential price reversal called failure swings. A bullish failure swing and a bullish and a bearish are the exact opposite of each other. So a bullish failure swing forms when RSI moves below the 30, then rises back up above the 30, then pulls back down again, but holds above the 30 level. So in other words, we've seen the indicator, let me just get my marker on here. We've seen the indicator fall down, go below the 30 level, move back to the 30 level, come back down to that 30 level, but holds it again. The failure swing is complete when the RSI breaks its recent high. This breakout is interpreted as a bullish signal. A bearish failure swing forms when RSI moves above the 70, then holds back below the 70 and then rises again, and then holds below 70. It's a little bit more complex, but we can see it here on this chart. So we saw the RSI move and it moved above the 70 level, fell back down, came back up, wasn't able to hold it, and then failed to make above that. And then when it broke the 50 line, that is a very good indication that we are now we've gotten a very good sell signal, a reversal signal for that asset. Now, as mentioned, interpretation of RSI, it's more a reliable indicator in ranging markets, can give misleading signals in hard trending markets. However, a modified interpretation of RSI can be used in a trending market, like we showed you in the presentation. For example, during a strong trend, RSI might move only between the 40 and the 80. In such case, RSI falling to 40 can signal a potential bullish reversal. So you have to look at the market that is taking place, the price action, where you are, and then you can then make your determinations on how you're going to use your RSI. Now, trend lines can be used on RSI oscillators also. It's the same way as on a price chart by connecting higher lows in an uptrend or lower lows in a downtrend. Breakouts above and below these trend lines can serve as to indicate a potential reversal in price. So when traders first learn about RSI and other oscillators, they tend to gravitate to overbought and oversold values, above the 30, below the 70. Okay, this is a too basic, it gives you some information, but it really doesn't tell you anything about really trading. So RSI is considered a momentum oscillator, and this means extended trends can keep RSI overbought or oversold for a long period of time. So think beyond the crossover of the 70 and 30 and look at other points or other ways and other interpretations you can use RSI, because you'll find that it becomes a very helpful indicator. So watch the center line above and below that 50 can be crucially important. And you saw in the presentation how we adjusted. Instead of using the 30, we would adjust it to 60 depending on the trend. Okay. So all oscillators have a center line, and more often than not, they become a forgotten backdrop compared to the indicator itself. RSI is no different with the center line found in the middle of the range at the reading of 50. Technical traders use the center line to show shifts in the trend. If RSI is above 50, momentum is considered up, and traders can look for opportunities to buy into that market. Just look for opportunities. A drop below 50 would indicate the development of a new bearish trend. So keeping an eye on that center line can be crucial. So the bottom line is RSI is popular because it has multiple uses. It is used to find entry and exit signals based on overbought and oversold readings and trending ranges, and can be help spot or confirm reversals via divergence. Like any technical analysis tool, though, RSI is prone to give false signals. Price analysis is still needed to determine if a trend is present, and then important RSI levels identified for that particular security. So that's our little informational webinar on RSI. It gives you hopefully a starting point of something how to think and adding it on to your trading. But RSI offers a lot of little intricate personal, you don't have to change the 14, you don't have to change the 30 or 70, but it's looking at that indicator because it will help you give you clues. It's no different than looking at price on a chart. By looking at that price, it's trying to tell you something. Same thing with RSI. And understanding, just not opening up some new asset that you've never looked at and dropping RSI on the bottom and say, look at what it's doing, because you have no comparative values. Okay. But if you limit your assets and start to use RSI regularly, you'll know how that RSI will work, number one, in the markets that we're looking at, because not forget the asset. If the market over itself is all congested, or the market is all over the place, the euro's soaring up and down, very volatile. Say it's an ECB rate decision. Okay, market's volatile. Well, all the assets in the euro should be doing not the same RSI reading, but should also have the same craziness, so you can see that, okay, this market today is giving us lots of false signals because it's got too much volatility in it, or it's a very quiet market. We have lots of congestion. Then for each asset, and if you're trading, a group of like the euro pound, the euro yen, the euro dollar, basically your RSI should be falling pretty much in the same, not the same levels, but using the interpretation should remain the same. But those same interpretations shouldn't be exactly duplicated over to Bitcoin. It shouldn't be exactly duplicated over to Amazon or the stock market. Find the little intricacies and innuendos that fit those markets, which will make you the best trader in the marketplace. So on that note, again, I gave you the handouts. The RSI handout will explain everything we discussed tonight, step by step by step. And just start somewhere. Start adding it onto your chart. Start looking at it. Start understanding it. But if you're using something like stochastics, you don't need to duplicate it. Stochastics and RSI, first you do the same thing. Sometimes a lot of people like to use MACD instead of RSI or stochastics because MACD has a trigger line that actually generates buy and sell signals. Okay, but overall, otherwise, that you end up duplicating. You shouldn't have RSI, stochastics, MACD on a chart. You're just spending your time with three basic indicators that tell you the same thing. Okay. So remember, don't make your charts and your strategies too complex. An indicator here and there, a couple clues, whether you're using price action, whether you're using chart patterns, and keep it limited. Keep it something you can handle. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. And remember, if you go to www.alvexo.com, sign up for their education webinars, and also use their education center, you'll find out how much you can learn and how much they'll help you understand how to use RSI. So have a good night now, and thank you very much for joining us.